Friends, how are you and how are you doing today? I hope you're actually having a very wonderful day. Again, I'm your host, your coordinator, your mentor, and the wealth surgeon and mind surgeon. And my name is Dr. Julius Oluwasegun Aroba. Welcome to this week's episode, and I want to talk to you about balancing risk management with wealth preservation. Now, in this time and age where every one of us are so busy acquiring so many assets or building our lives, there's a lot of things that we've not been able to put in place. And this is why it's good for you to know how to balance risk and wealth management. How about if we go into it deeply? Because in finance and life, there are two powerful forces constant interacting together. And this is why it's very important for us to be able to know what does the word risk management mean if we're breaking it down. And also, if we're also talking about it in the other perspectives, what does wealth preservation mean? And it means that when you're talking about risk management, it means about you identifying and assessing and controlling potentials that might arise of the course of wealth preservation. And when we talk about wealth preservation, it means by we protecting accumulated assets from erosion, loss, or volatility. And these are some of the things that we've got to know how to be able to maintain the risk, and also looking at how we can actually preserve that wealth. Right. How do we balance it? The two, because they are one of the major key things that helps us to be able to look at how to take growing responsibilities and exposing ourselves to destructive losses. Because accidents happened. And a lot of people do not even know how to be able to preserve, how to maintain, how to keep, so that the wealth can actually be translated to whoever, the generations or the teams of people that are within the areas. Now, how about you ask yourself, because there is a certain rule according to Warren Buffett that he once mentioned, that in the rule of business, whatever you want to do in rule number one is never lose money. And rule number two is don't forget rule number one. How about if you look at that, if you don't forget that, because while you keep growing, it's very important for you to be able to know how to maintain and sustain your wealth and also to preserve it. It's one of the things that is kind of going to help you to be able to know how to put things together. Friends, you as a career person that is actually watching this, how do you know how to understand the risk management and what is risk? Those are key terminologies that we are going to look at today. Risk is about the possibility that the actual outcomes will differ from expected outcomes. And in this life and age and time that we're in, risk actually comes in different forms. There are high risk, there is low risk, there is human risk, there is credit risk, there is accident risk, there is investment risk, there's operational risk, a lot of them. Market risk is about economic downturns. And when we talk about credit risk, it means about your credit score of what you do, of the business that you are into. Maybe you are somebody that is actually trying to know how to control your credit and you don't know how to. It is also a risk. Do you know that yourself, if you don't know how to be able to control your credit in life, in terms of your credit card, in terms of how you go about your expenses, there is no how you can be able to see how to put things in place. Now, that is also a risk as well. And when we're talking about liquidity risk, it means about inability for you to be able to access funds. Because if you're not liquid in nature, if you're not having the right access to finance, it means you're actually having a risk in that area. Operational risk, it means that systems or structures or operational method that you put in place might actually fail. Now, when we talk about personal risk, it can be maybe illness, it can be maybe you lost your job or your business, or you lost a deal, or somebody developed disability in the course of that business. Now, we've talked about various versatility. How do you be able to now look at risk management process? There is a lot of way how one can be able to manage that risk so that one can live for a very good, better time. And number one is for you to be able to know how to identify risk. Because if you don't know how to identify the risk, there's no how you can be able to assess the impact and the practicality of that risk. And it's very important for you to also know how to categorize risk. Because risk can actually be in high, it can be low, it can be medium. You've got to know how to be able to. Because if you don't put these things in place, there's no how you can be able to know how to prioritize them. And again, risk can actually be transferred or it can be mitigated. A lot of people in this time and age, as you are a career person or somebody who is an entrepreneur or a business owner that is actually on this road or this journey to be able to know how to mitigate risk, you've got to see how to put diversification of risk management in place. That's where we start talking about credit, and we're talking about insurances, maybe life insurance for personal, maybe business insurance for your business, maybe in terms of credit insurance or facilities insurance and things like that, so that when anything happens, you can be able to know what to fall back to. Again, another one that is so common and so personal is that a lot of people will say life insurance is not important, health insurance is never important. But do you know that anybody can fall sick at any time and anything can happen to you at any time? God forbid, if you fall down, if your business collapses, what are you going to do? Who are you going to fall back to? And who is going to be able to fall back to that? You see, maybe you're actually paying this money bit by bit to get to that level and you're not able to. Now, you've got to know how to look at monitoring the risk continuously. When we're talking about this, there is also, for you, there is a very good understanding for you to be able to know what I call wealth preservation. We talk about risk in diversifications, risk in different forms. Understanding wealth preservation actually comes very handy. Remember, we're talking about risk management versus wealth protection, wealth preservation. Wealth preservation focuses on protecting capital, and also it's about maintaining purchasing power. It's about you reducing unnecessary exposures, and it's about you ensuring generational continuity in anything that you do. Because if you're not able to know how to protect your capital, it means your investment, it means your knowledge, it means with that business you've actually been investing into. If you're not able to protect it, how are you going to be able to know how to be able to have a right purchasing order? A lot of people are just living, but they're not even living to know how to actually know the right to power of purchasing. Because when you have capital, you have money, you have some things that you can actually exchange as a collateral. It means you have a right purchasing power. You want to be able to reduce unnecessary exposures of whatever you've got. You've got to be able to protect it so that the government doesn't come for it, so that your allies do not come for it. Your business is actually be ensured that people can actually know that, yes, this is a business that's just worth it. And again, when you're building a business, don't build a business for 5 years, for 10 years. Build a business for 100 years, for 200 years, which is what I call generational business translation. Because if you're only building for today, there is no how you'll be able to build a business for next tomorrow or for generations and generations to come. And if you want to be able to build a business that lasts, just as Google, like Amazon's, like Facebook, take a lot, and so on and so forth, in different areas, you've got to think system. You've got to think about generations. You've got to see how to put the right structure and the right system in place so that things can actually go better for you. Benjamin Franklin once said that an investment in knowledge pays the best investment interest in life. Because whatever you know today will be able to help you to protect your knowledge, your discipline, and your foresight, because you can think ahead. Whatever you actually invest into in terms of your personal self is the thing that's going to pay interest tomorrow, because you develop system, you develop people, you build a community, and all these things are actually very good. Now, point number 4, I want to talk about the growth versus protection. What do we mean about growth versus protection? It means in every area, in everything that we do, there is much essence for us to be able to know how to run the risk of avoidance. And again, risk of avoidance actually helps us to be able to know how to determine the low returns or wealth erosion from inflations. Because if you're not able to determine some of these things, there's no how you can be able to know what is the right method and mechanisms for you to put in place. Because when you have too much risk taking, potential for catastrophes can actually happen. And that's why you see a lot of people, they don't even calculate their risk. I know you are saying Forex, you're saying the capital market, you want to put all your eggs into it. Imagine if you invest all the 100% of whatever you have today, and anything happened in the capital market and you lost most of all those things. Do you know a lot of people have actually killed themselves in the course of this? You've got to know how to be able to determine the risk, because the higher the risk, the higher the return. But the lower the risk, the lower the return. Now, you want to be able to categorize your funds or your investment as a business person or as a career person. Maybe, for example, you want to be able to sell in cryptos or currencies. I'm not an expert to be able to advise you in this area, but I'm only giving you an example as a case study. You want to be able to select some certain amount of money to put maybe about 20% into a high risk, then a medium risk 30%, then about low risk for about 15 or 20%, and so on and so forth. You've got to be able to know how to capitalize and put these things in place that could help you. Now, what do you do when it comes to you balancing all of this? Is that you've got to take what I call calculated risk. Because for every risk, there's always a calculation in it. You've got to know how to diversify, just like I've said. And you've got to know how to strategic allocate your investment or your investment in any of this. And you've got to look at how to be able to have weekly, monthly, daily review in all these various risk investments. Because if you're not able to calculate this and be able to monitor it religiously, you might lose it in different areas. Now, let's look at a case study of an aggressive investor, somebody who's very aggressive. And that person, let's say, for example, James, or let's say Joyce. There are two names that I want to leave as aggressive investors. And maybe they are at the age of 35 to 40. And they because they've not been able to invest over the years, now they want to take all this risk, which is aggressive-wise. They want to be able to invest whatever they earn, 90% of them. And instead of them putting it into savings, they want to put it into high-risk investments, stocks during the market boom. Because when the market boom, a lot of people rush into it. And you know what happened? At the end of the day, this recession now hits in the capital market. And all their portfolios that they've invested 90% into, everything now drops to 50%. Do you know that at that point, some people even have the urge to even fast sell because they just want to pull out? Now, as somebody who is panicking, you don't want to sell at loss. You want to be able to take time to calculate. Maybe the market is still going to go. Maybe there's still going to be hope, because lack of risk management will destroy your wealth accumulation. And what should you have been done? What should they have done, Joyce and James? They should have actually looking at the example that I gave, which is diversification across asset classes. Asset classes, there are physical, there are different asset classes. There are paper assets, there are virtual assets that one can diversify into. And they've got to be able to look for how to be able to have investment emergency savings. Because if you're not able to have an emergency savings of 3 to 6 months, when you lose that business, when you lose that investment that you have, or when you lose that job that you think you have, what's going to happen to you in about 3 to 6 months? Are you going to be still able to have something that you can fall back to? Or you are somebody that does not even think about some of these things because they're emergency, and you've got to think through it. Right. You've got to allocate based on risk tolerance. Now, another case study I want to talk about is about overly conservative saver. Somebody who saves. Now, let's say another case study, let's say James or Maria. They save money only in a low interest bank account for 15 years. Do you know that any money you keep in your bank account for 15 years, that money is going to lose value? And what happened over time? Inflation would have eaten that money in your bank account. And your purchasing power of your real wealth is going to be low at that point. And what should they have done? They should have actually avoided risk entirely, and by creating risk inflations. Friends and family, the three case studies, the third one I'm going to share with you today is about the farmer and the seed. Now, I don't want to mention a name because anybody can be a farmer. A farmer who kept all his seed from those harvests, the crops, and locked them away to avoid loss over the years. Do you know another farmer, let's say farmer B, actually carefully planted some and he kept some across different fields. Maybe he planted tomatoes or maize or maybe cassava or maybe potatoes and so on. But the other farmer did not actually plant anything. He locked them away because he's waiting for the appropriate time. Do you know that the one who diversified, who did not lock it, over the years, when storm comes, no matter how the storm comes, yes, storms are some of the risk of life as a farmer. Now, when the storm comes, they might erode some of those, maybe in the potato area or in tomato area or in the different sectors, in the segmentations of those crops. At the end of the day, there's no possibility that all of them is going to be lost. Now, you know what will happen? The farmer will diversify in different harvest fields. If it is being harvested, the food are going to be able to produce more money for him. And do you now know what happened? The one who avoided the risk, starving, saving, because it doesn't want to invest into anything. Do you know that he wouldn't even have anything to be able to fall back to? Only that he only has something that is savings. That is the case study you need to really consider. Now, that money you have in your bank account for 15 years, for 20 years, is going to lose the purchasing value. And when that money loses the purchasing value, how are you going to be able to see what you do in that? And this is why I'm going to tell you a practical step-by-step guide for you on your daily life as a career person or as an entrepreneur, as somebody who is building. Step 1, you've got to build a risk awareness mindset. And these are some of the questions you're going to be asking yourself, which is, what could go wrong financially if I go into this deal? Even when I lost this deal, am I still going to be... You've got to ask questions. How would I survive if I lost the income? If I put all my eggs in one basket, am I overexposed to one source of income, or I need to have different diversifications of income? Step 2 is that you've got to create what I call emergency fund, 3 to 6 months living expenses. You keep liquid in your account that you know you can actually touch, or you can put it in an investment, in a saving investment that you can cash out when there is need for it within that period, instead of the money just lying down in your bank account. And you've got to be able to know how to access that money so that the money can actually be accessible at that period. And now, do not invest emergency fund in a volatile asset. That's a mistake a lot of people make as a career person, as an entrepreneur in this time and age. You've got to know that living expenses that you are creating for 3 to 6 months, put it in something that you know that is secured, that is not in high risk, so that when you want to have access to that, you can be able to go into it to be able to pluck it out. Number 3 is that you've got to protect against catastrophic risk. And how will you be able to do that? Catastrophic risk happen. Anybody can die anytime. Your business can collapse anytime. Anybody can take you. And disability can also occur anytime. And also, property insurance, business insurance, all of these things might erode some of this. But when you put protection in place, such as different insurances, it's going to help you to be able to fall back to. Step number 4, you've got to diversify income daily. You've got to diversify income weekly in your business, in your career. You've got to look at, what does my primary job brings, and what does the side businesses bring, or different arm of your businesses. Maybe you only created one arms, but now the money, the profit that is coming from that business, you don't want to spend it on anything. You want to be able to create another streams of income for your business, so that when one is not moving, the other one is also moving. Even for you as well, for you as a career person that only have just one job as a source of income, why not start something at the side, so that if you, in case you lose that primary job, you can fall back to something. Side businesses, investments, skills development, invest into yourself in having a lot of this. And one of my mentors once also said that don't put all eggs in one basket, because if you put all eggs in one hope, in one person, one business, one career, when anything happens, you're going to lose. Now, number 5, diversification of investment, is that you've got to balance your portfolio in different areas. 40% of your equity growth, 30% in bonds and stability, and 20% in real estate, commodities, and so on and so forth, and 10% in cash liquidity. Friends, after you've done that, step number 6 is for you to be able to protect against inflation. And inflation happens anywhere in the world, all over the world, inflation happens. And invest in assets that can actually help you to outpace inflations. And you've got to avoid keeping excessive idle cash anytime, any day, in anything that you do. And you've got to review it over time and over the years. Friends, when we're talking about the summary of this today, is that risk management can actually help you to have what I call budgeting in terms of overspending. And wealth management is about you building savings. And risk management is about you reducing career risk. And in terms of wealth preservation, it means you've got to increase your earning power. And when you talk about risk management, impact in terms of regular savings, you've got to manage timing risk. And when you talk about wealth preservation in terms of impact, it means you've got to build long-term wealth. This calls for annual review in terms of detecting new threats and also adjust strategy. What are the key principles that you've got to be able to look out for? Control by eliminations, only manage. Preservation without growth leads to decline, and growth without protection leads to collapse. Discipline beats emotions, time struggle strongest daily, and stay on course. On a lighter note, if you're not following us on different platforms, on Spotify, on YouTube channels, on LinkedIn, on Instagram, or Facebook, please just go to Julius Aroba and just follow us. Send us a request if you're looking for how to be able to build and how to get a mentor that can assist you in your businesses, in your career, because you don't want to remain where you are. And how long are you going to do this? Why not go to www.juliusaroba.com and drop us a DM or send us an email, and our team will get across to you. I hope you've actually been able to learn about risk management and wealth preservation. I'll see you again in our next episode. God bless you. Goodbye for today.